Welcome to MSS Mentorship and Online Classes. I am Mohamed Sheikh Sisi, your tutor and your mentor. Today, we are going to cover IAS 16. Let's take a look at the flow chart for tangible non-current assets, as it contains some of the most relevant IASs and concepts you need to know for the financial reporting examination. So we are going to look at investment properties, which is covered under IAS 40, and we are going to look at the tangible non-current assets. We are going to look at the measurement as per IAS 16. We are going to look at depreciation under IAS 16. We are going to look at the change in method, the change in estimate, and we are going to look at how we can depreciate component costs. Also, we are going to look at revaluation under IAS 16. We are going to look at the accounting for revaluation, and then we are going to look at the depreciation of revalued assets. Finally, we are going to look at the disposal of revalued assets. We are going to cover borrowing costs as per IAS 23. We are going to look at government grants under IAS 20, and we are going to look at the revenue treatment of government grants, and we are going to look at the capital aspect of government grants. So we are going to start looking at property, plant and equipment, IAS 16. And when we are talking about property, plant and equipment, PPE are tangible assets held by an entity for more than one accounting period for use in production or supply of goods or services or for administrative purposes. The machinery we are used in the production process is classified as property, plant, and equipment. So we need to know the definition of PPE. Also, we are going to look at the scope of PPE as it excludes biological assets, which is covered under IAS 41, investment property, which is covered under IAS 40, and we are going to exclude IFRS 5, which is non-current assets held for sale and discontinued operation. When we are going to look at these accounting standards, we are not going to look in line with IAS 16. We are going to follow what IAS 41, IAS 40, and IFRS 5 state about the treatment of investment property, of assets held for sale and discontinued operation, and a biological asset. So let's move to the recognition criteria, as we have covered the conceptual framework. So this is just to revise so that everyone can get the further understanding with regards to the recognition criteria. So when we are talking about recognition, it means whether or not we need to show this as an asset or as a liability. For instance, we are talking about the recognition criteria for PPE. Before we are going to include an item as a property, plant, and equipment, we need to ensure that it meets this particular two criteria for recognition. One of the criteria is the definition. The item should meet the definition of property, plant, and equipment, of an asset, before we are thinking about recognizing that particular item. The second condition, which is also important, is the measurement reliability. We need to have costs that we can allocate to that particular item before we are going to recognize it, because without the cost, we can't able to recognize it. So these two conditions should be met before we are going to recognize an item as a property, plant, and equipment. So we need to know this recognition criteria as well. So now we are going through the measurement. It is very important we know the two types of measurements. We have the initial measurement and we have the subsequent measurement. So for the initial measurement, we are going to look at all directly related costs in bringing the asset into working condition. This is the key things you need to know. When we are talking about cost, it means all directly related costs in bringing the asset into working condition. All these costs should be capitalized, should be included within the calculation of the value of the asset. So include in this initial cost of cost such as cost of site preparation, delivery cost, installation cost, borrowing cost. We are going to look at borrowing cost separately under IAS 23, but for now, let's assume we took out loan to finance the acquisition of this asset. So automatically, the interest we are going to pay on this loan, should be capitalized as part of the cost of the asset, because the purpose why we took the loan out is to finance this specific development of this asset. So the interest we are going to pay on annual basis, we are going to capitalize that particular interest, but we are going to look at it separately under IAS 23. Also, we need to note few points. Expenses items, such as fuel, training, warrant cost, should not be capitalized. We need to write them off immediately. Also, we are going to look at dismantle cost, very important concept for us to understand, and it has a lot of other aspects that's also important within the course. So when we are talking about the dismantle cost, for instance, if we develop a machinery using the manufacturing process, based on the agreement with community people with regards to sustainability, we agreed that at the end of the life of the machinery, for instance 10 years, we are going to dismantle this machine and we are going to dispose it of whatever, but we are going to dismantle the machine. So now in 10-year time, we are going to spend, for example, 4,000 leons to ensure we dismantle, or $4 million to ensure we dismantle this particular machinery. So now we have an obligation to pay 4 million in 10 years time. So what the concept of dismantle cost is saying that we need to discount this future cost, this 10 years, this cost we are going to incur in 10 years time. We need to discount this cost to its present value as of now, as of today. What will be the equivalent value of this $4 million? What will be the value as of today? Now, what will be the value of this $4 million we are going to pay in 10 years time? So this is the concept of dismantle cost. And also this concept will give rise to the recognition of a liability, because after we have discounted the cost, we are going to debit the asset and we are going to credit liability. And why are we going to credit liability? We are going to look at it when we are going to solve the question. So now we have a formula that we are going to use to discount the $4 million to present value, which is referred to as a discount factor. We also need to understand it. By the way, we are going to see it when we are going to do financial management and other AFM as well, advanced financial management. So this is discount factor 1 divided by 1 plus r raised to the power n, or in bracket 1 plus r raised to the power minus n. It will give you the same answer. So r represents the interest rate, which will be given in the examination, and n is the number of years. So now let's take a look at example 1. Let's try to solve example 1 so we can understand the concept well. So now let's read the question. So we are going to look at example 1, and then construction cost is 8 million, site preparation 2 million, installation 4 million. Also, based on the environmental impact, it is required to dismantle or remove the asset in 10 years at a cost of $4 million. Interest rate is 5%. So now the requirement stated that we need to calculate the cost of asset, depreciation, and how the liability is treated. So we can start with the cost. Now we have the construction cost, which is 8 million. We have the site preparation cost, which is 2 million. We have the installation cost, which is 4 million. Now we are going to include the unwinding, the dismantle cost. We are going to include the dismantle cost. So we are going to do separate working for dismantle cost. So we are going to do working 1 for dismantle cost. So when we are talking about dismantle cost, we need to discount the 4 million we are going to pay in year 10. We need to discount it to present value. What will be the value of the 4 million in 10 years time? What will be the current value as of now? So now we are going to calculate the present value, which will equals to the future value, the 4 million, times the discount factor 1 plus r raised to the power n. Raised to the power n. So now we are going to solve 4m times 1 divided by 1 plus 5% raised to the power 10. So let's use our calculator. 1.05 raised to the power 10, 1 divided by answer, times 4. So the answer will be 2.456 to 3 decimal place. So this will be the answer for the present value. So it means as of now, the value of 4 million in 10 years time will be $2.456 million. So now this amount, we are going to debit the asset and we are going to credit liability. So it is very much important we understand the concept. We need to understand the concept. So now we are going to include it 2.4. So our total asset will be 16.456. This will be our total asset. So we have calculated our total asset. So now we are going to calculate the depreciation. For now, let's keep it simple. We are going to look at the concept of depreciation separately. So depreciation equals to the cost 16.456 divided by the number of years, which is 10 years. So let's use our calculator. So divide by 10 years. So it gives us 1.646 to 3 decimal place. So this depreciation, we are going to debit expense and we are going to credit assets at the end of the year. So we are going to debit expense by 1.646 and we are going to credit the asset 1.64, accumulated depreciation. So for the first two requirements, this is what we are going to do. Then the final requirement, how we can treat the liability. Let me just explain the concept why we credit the liability, because it's very much important we understand. Now, as an accounting student, for any concept, you need to know the basis, you need to know the reason. Now, when we are talking about liability, if we are looking at the definition of liability, there should be a present obligation as a result of past events, which can result to outflow of economic benefits. So these three factors, whenever we want to recognize a liability, we need to consider these factors. So now, firstly, let's assess whether we have an obligation with regards to the dismantle cost, which is yes, because in 10 years' time, the community, the environmental people are expecting us to dismantle this particular machine. So as a result, we have a legal as well as constructive obligation to dismantle the machine, so which is fine. Also, it will be as a result of past events, which is obviously clear. Then the final aspect of it will result to the outflow of economic benefit, which we are going to pay the 4 million in 10 years' time. So all the conditions are met. So we are going to, recognize a liability. So this is the reason. Now, we are going to do working two. Working two. Very much important. Right? So now, what we are going to do to ensure we understand, we have discounted the $4 million to $2.456 million, and we have recognized the assets, and then we have recognized the liability. So now we need to ask, how are we going to account for the difference between the 2.456 and the $4 million, which is very much important, because at the end of year 10 we are going to pay 4 million, but as of now we only account for 2.4. So now we have the concept of unwinding. So what the concept of unwinding is saying is that we need to allocate on annual basis. We need to expense a specific amount, which will be the interest rate multiplied by the closing liability value. So now we are doing this on annual basis to ensure that on annual basis we are going to increase the liability. So at the end of year 10, we are going to increase the liability year on year to ensure that at the end of year 10 we have the $4 million that we are going to pay. So it means on annual basis we are going to expense the unwinding, we are going to debit the unwinding, expense it, and then we are going to credit the liability to increase the liability. So this 2.4 in 10 years time, when we are going to credit the liability, it will give us the $4 million we are supposed to pay. So now let's look at the working so we can understand better. So now we need to note one thing. When we are calculating the unwinding is calculated using the interest rate times the closing liability So you need to note it down. When we are going to calculate the unwinding, we are going to multiply the interest rate times the closing liability. So now let's take for year 1, for the first year 1, the closing or total liability equals to the 2.456. So the unwinding will equals to 5% times 2.456. So this will give us the amount we are going to debit as expense and the amount we are going to credit as liability. So it will give us 0.1228. So now what we are going to do, we are going to debit. Sorry, let me put the account treatment separately, and so we can see it properly. So now we say liability. Year 1, we are going to debit expense network is giving problem. Sorry about it. Let's continue. So we are going to debit expense with 0.1228 and we are going to credit liability by 0.1228. So crediting liability means we are going to increase the liability. So this is for year 1. So we are going to do another working for year 2. So year 2, we are going to calculate the closing liability or the total liability. Closing liability equals to the 2.45, the opening liability, plus the expense liability, 0.1228. So 2.456 plus 0.1228 will give us 2.5788. So we are going to multiply the 5%. We are going to apply the 5%. So unwinding equals to 5% times the closing liability, 2.5788. So this will give us times 0.05, 5% will give us 0.12894. So for year 2, we are going to debit expense with 0.1289 and we are going to credit liability with 0.1289. So this is how we are going to do. We are going to do the same for year 3 till year 10. So automatically at year 10, the closing liability will equals to $4 million. So basically, this is the concept you need to know for unwinding. So you need to take a look at it technically so you can understand the basis and the reason So now we are going to look at subsequent capital expenditure. So when we are talking about subsequent capital expenditure, we are talking about major expenditure we are going to incur relating to that particular asset. Now, the key things you need to know is that when we are talking about major expenditure, this expenditure should enhance the economic benefits provided by the asset. So what I mean is that, for instance, if the machine capacity is 10,000 bottle of water, because of the capital expenditure, the production quantity should increase from 10,000 to 12 to 11, for example. The basis for capital expenditure is to ensure that the machine, the assets, enhance its economic benefits. So without this condition, we are not going to include it as a capital expenditure, or we are not going to capitalize it. Instead, we are going to expense it. For example, we are talking about annual maintenance of the machine. We are talking about painting of the machine, for example. This cost, should not be capitalized as subsequent expenditure. We need to expense it as a revenue expenditure. So these are the conditions you need to know, because they are very much important for us to understand. When we are looking at the past questions, we are going to see some of these criteria. So it is important as a student you able to understand this concept. But the key point you need to know, the expenditure incurred should be as a result of improving the particular asset. The improvement should result to an increase in the economic benefit the asset is providing. Very simple and very easy to understand. So now let's take a look at example 2. And it's very simple to solve. We are not going to crack it. I'm just going to explain. From example 1 above, due to the increase in demand for the product, the asset required expansion to meet increase in the demand at a cost of 1.5 million. So now if we are looking at from example 1, the total cost was 16.456. So we are going to add this 1.5 million to the 16.456 to give us our recent cost of the asset, because this is an expansion and it will increase the demand. So automatically increase in demand will give rise to the increase in the economic benefit that the asset has been providing for us. So we need to note it down. Let's look at example 3. A piece of machinery has an annual service cost of $10,000. During the most recent service, it was decided to replace part of the engineering, meaning that it will work faster and produce more units of product per hour. The cost of replacement part is 20,000. So now the question is saying that we need to which one of the costs should be capitalized and which one of the costs should be expensed. Now it's simple. The piece of the annual service cost should be expensed because it is an annual cost, and also it will not result to enhance the economic benefits the asset is providing. Then also the cost of replacement parts, which is very much important, a major component needs to be replaced. So since the component is major, it will enhance the economic benefit. Then we are going to capitalize. We are going to capitalize the $20,000. We are going to include it as an asset. So this is the concept we need to know, and then about the subsequent expenditure. For the IAS, we are going to cover how we can, deal with the subsequent expenditure. So now we are going to look at subsequent measurements. After the initial measurement, the second year, how we are going to continue to measure, to calculate the value of the assets. We either have two approach. We have the cost method and we have the revaluation method. When we are talking about the cost method, it means the cost less accumulated depreciation or impairment. So very simple. If we are going to maintain the cost model, then we are going to use the cost less the accumulated depreciation less impairment. Now, if we are going to use the revaluation model, we are going to look at the fair value at the revalue date with less the depreciation. Anyway, we are going to look at this concept in detail separately. So for now, we just need to know that we have two measurement approach for subsequent. I'm not talking about initial. For the second time, we are going to calculate the cost of the assets. We have two options. Either we use the cost model or we use the revaluation model. We can decide on which model to use based on the one that will give the faithful representativeness of the financial information, the relevant information. We are going to look at it, in different standards, and also when we are going to cover IFRS 13, the fair value measurement, we are going to look at the fair value for the revaluation as well. So now we are talking about depreciation, very important concept we need to know. It's not only important for IAS 16, we can use it in other IASs as well. So we need to pay attention to understand the depreciation. And when talking about depreciation, simple, this is the allocation of the cost of the asset over its useful life. For instance, if the cost of the asset is 10,000 and useful life, is 10 years, it means on annual basis, yearly basis, we need to allocate 1,000 as the cost of the asset. So at the end of year 10, we are going to expense the whole cost of the asset. So this is the concept you need to know about depreciation. So now, when we are talking about depreciation, you need to understand these bullet points. Depreciation must be charged from the date the asset is available for use. Very good. When we are going to look at when to capitalize and when to capitalize, we are going to understand this particular aspect of depreciation. But for now, we can charge depreciation when the asset is available for use. It is capable of operating in the manner intended by management. If the asset is to improve in production, then the operating capability should be determined based on management's discretion. So we need to understand that as well. This may be earlier than the date it is actually brought into use. For example, if staff need to be trained to use it, depreciation is continued even if the asset is idle. We need to note that down as well. The depreciation method used should reflect fairly as possible the pattern in which the asset economic benefits are consumed by the entity. So now what they are saying, we don't need to use a depreciation method that is not presenting fair financial information. Either we decided to overstate the expenses so we can reduce profit for one reason or another, or we decided to reduce our depreciation so we can increase our profit for one reason or another. So IAS 16 did not allow short treatment for the depreciation. It should be fair, and then it should replicate the asset economic benefit. For instance, for a computer, the standard time is 5 years. But if you decided to depreciate the computer for 10 years, it means the economic benefits will not be will not be yield based on the utilization of the computer. So now we have different possible methods we are going to use to calculate depreciation. We have straight line, we have reduced imbalance, we have the machine hours. We are going to look at it. Also, a change of one method of providing depreciation to another, we need to look at it as well, as whether it's a change in estimate or it's a change in policy, which is a change in estimate. We need to look at it, and we have accounting standard we are going to cover to distinguish whether a change in depreciation method is a change in estimate or a change in accounting policy. It is permissible only on the ground that the new method will give a fair presentation of the result and of the financial position. Point to note, does not constitute a change of accounting policy. So it means the change in the depreciation method from straight line to reduced balance is a change in accounting estimate. It's a change in accounting estimate. Fine. The carrying amount should be written off over the remaining useful life. The carrying amount, we need to note it down. The carrying amount should be written off over the remaining useful life, commencing with the period in which the change is made. If an asset is made up of a number of components, each separate part of the asset should be depreciated over its useful life. If an asset is made up of number of components, each separate part of the asset should be depreciated over its useful life. Example, an engine with an aircraft will need replacing before the body of the aircraft needs replacement. So we need to know it as well. So now let's solve example 4. Very important question we need to know. So we need to understand the question, and then as understanding the question, so the requirement, what is the depreciation charge for the year ended 31st December 20x5? 31st December 20x5. So it means our financial period starts the 1st January, 12 months. So now let's go through the question. An entity purchased an asset for $20,000 on 1st January 20x3. So date of acquisition, working, date of acquisition is on the 1st January 20x3 for 20,000. Straight line depreciation of 5,000 per annum has been charged, assuming a 4-year useful life with no residual value. So we say useful life equals to 4 years with no residual value. On the 1st of January 20x5, on the 1st of January 1, 20x5. So it means January to December 20x3 1 year, January to December 20x4 2 years. So the asset has been depreciated for 2 years. So we need to calculate the carrying value as at the 31st of December 20x4. So we need to calculate the carrying value. So we can say carrying value, we need to determine 1st January 20x3. This is the cost of 20. Depreciation, x3 depreciation is 5,000. Depreciation 20x4 is 5,000 again. So now the carrying value of the asset is 10,000. As at carrying value at 31st 12 month x4. So this is the carrying value. So now what we need to do, we need to depreciate the asset further, because the requirement stated that we need to calculate depreciation charge for the year ended 31st December 20x5. The year ended 31st December 20x5 depreciation. So we are not interested in this depreciation. We are not interested in this depreciation. We only need the depreciation for December 20x5. So on 1st January 20x5, the annual review of asset lives was undertaken, and the remaining useful life for the asset was estimated at 4 years. So after we have reviewed the useful life of the asset life has increased, to from the remaining useful life of 2 years to 4 years. So now we are going to depreciate the asset based on 4 years now. So now our current year depreciation, which is the depreciation for DEPN for X5, will equals to working 2. So depreciation for x5 will equals to 10,000 minus the scrap value, which is not given, divided by 4. So our depreciation we are going to deduct will be 2,500. So the remaining value of the asset will be 7,500. But the requirement is to calculate the depreciation for 20x5. So this is the solution and we need to understand it. So now let's look at the concept we use to calculate this particular solution. Now the carrying amount should be written off over the remaining useful life. The remaining useful life was 2 years, but because of they decided to review the useful life of the asset, it resulted to the asset value to increase to from 2 years to 4 years. So very important concept we need to know. So furthermore, we are going to look at Furthermore, we are going to look at the evaluation of non-current assets. Very important concept we need to put under control. According to IAS 16, it allows a choice of accounting treatment for property, plant, and equipment. Now, when we are talking about evaluation, it means we are going to, based on the revaluer, we are going to assert a current value of an asset, the most fairly presented value. We are going to, assert it to the assets. We are going to revalue. We are going to bring new value of the assets, not any type of value. We're going to bring a value that is realistic, that will give a fair presentation. For instance, if we look at our environment, 10 years ago, 10 years ago, land, was sold for, let's say, 10,000 leons, for example, or $100, for example. As of now, the value for land, has significantly increased. So let's say from $100 to $1,000, $2,600, for example. So the evaluation, will give the updated figure based on the external factor, based on the current economic situation. So now, as per IAS 16, we have the option to the choice of accounting treatment for property, plant, and equipment. Either we can continue with the cost model, which is fine, or we can we can start using the revaluation model. So when we are going to use the revaluation model, it is very much important to understand. We are talking about revaluation model. Property, plant, and equipment may be carried at a revalued amount less any subsequent accumulated depreciation. If the revaluation alternative is adopted, two conditions should be applied. 1. Evaluation must subsequently be made with sufficient regularity to ensure that the carried amount does not differ materially from the fair value at each reporting date. First point we need to know. Second point, when an item of property, plant, and equipment is revalued, the entire class of assets to which the item belongs must be revalued. We need to understand these 2 points. We need to understand these 2 points. So now, let's look at the accounting for revaluation, the step-by-step approach to how we can account for revaluation. Now, step 1, we need to restate the asset cost to the new valuation. In other words, when we are going to revalue the asset, we need to determine the carrying value of the asset before the date of revaluation. For example, if we are going to revalue the asset as at December 2025, we need to know the carrying amount on that day before the revaluation. So we are going to start the process from that day before the revaluation going forward. So second point, we need to eliminate any existing accumulated depreciation for the asset. We need to eliminate it. We are going to look at it when we are going to solve, practical question. Show the total increase in other comprehensive income. So now, if we have increase in the revaluation, we are going to show it under the comprehensive income at the foot of the statement of profit and loss. When we are going to look at IAS 1, we have separate component, which is the other comprehensive income, that is a little bit distinct from the attributable profit. So we are going to look at it separately. Don't worry about it. This will then be taken to the revaluation surplus. So now, when we have an increase in revaluation, what I mean by increase is that if the carrying value of the asset before the revaluation is 10,000, then due to the revaluation, the value has increased to 12,000. The 2,000, will be shown as other income, and we are going to credit the revaluation surplus. So much like the profit for the year gets taken to the retained earning, we are going to look at it as well. So now we are going to look at how we can recognize the revaluation gains and losses. Very important concept. Now, evaluation gains are recorded as a component of other comprehensive income, either within the statement of profit or loss and other comprehensive income, or a separate statement. For now, let's assume it is single one, because when we are going to look at IAS 1, we are going to cover, the distinction between the statement of profit or loss and other comprehensive income, or in the separate statement. This gain is then carried in the revaluation surplus within the equity. So we are going to show it as other comprehensive income, and we are going to credit the revaluation surplus under the statement of changes in equity. This revaluation surplus is a capital reserve, and it is therefore not permitted to be distributed to the shareholders. That's why we are going to show it as a revaluation surplus under the statement of changes in equity, because it is not permissible to be distributed to shareholders. Revaluation losses, which represent an impairment of an asset value, are recognized in the statement of profit or loss. When a revaluation losses arise on the previous revalued asset, it should be deducted first against the previous revaluation gain, and can therefore be taken to the other comprehensive income in the year. Any excess will then be recorded as an impairment expense in the statement of profit or loss. Fine. So now, for us to understand this one, we need to understand the prudence concept. Now, the prudence concept stated that we should not recognize gain until it is realized. For a gain, we should not recognize gain until it is realized. When talking about recognize, we should not show it as other income and a statement of profit or loss. I'm not talking about other comprehensive income. I'm talking about other income. For instance, after we have calculated the gross profit, we have other income, we have expenses. The other income, we should not recognize, revaluation gain based on the prudence concept. But when we are talking about loss, when we are talking about losses, the prudent concept stated that we need to recognize the loss even if it is not realized yet, even if we did not spend the money yet, but we need to recognize the loss since it is feasible and it is realistic. We need to recognize the loss. So this is the concept we are going to apply, when we are going to account for the revaluation gain and or the revaluation loss. We need to know the prudent concept. Now, the technicality lies within the revaluation loss. Let's go again the second paragraph. When a revaluation loss arises on a previous revalued asset, for instance, we have been revalued the asset previously, and we have some amount seated in the revaluation surplus as gain. So now if we decided to revalue this asset again, then there is a loss in the revaluation process. We need to know how we are going to account for this one. It should be deducted first against the previous revaluation gain. So now, for instance, when we are looking at the revaluation gain, we have $10,000 within the revaluation gain. Now, when we are going to do this revaluation, we have a revaluation loss of 5,000 yuan. So it means we have sufficient revaluation gain in the reserve to offset this revaluation loss we have in the current year. So what we are going to do, we are going to ensure that the revaluation loss is first set off against the previous revaluation gain. So we are going to deduct the 5,000 from the 10,000 euros. This is what we are going to do. Now, if there is any excess revaluation loss, for instance, let's make the example different way. Now the revaluation reserve amount is 10,000 euros. Then during our current revaluation process, we have a loss of 20,000 euros or 15,000 euros, for example. Our revaluation reserve gain is showing 10,000. Our current cost is showing 15,000 euros. So what we are going to do, we are going to ensure we recognize the revaluation loss first in the revaluation gain, and if any remaining, then automatically we are going to recognize it as expenses in the statement of profit or loss. As impairment, we are going to recognize it. Now we have looked at the two scenarios. Now what if what if we don't have any previous revaluation gain for this particular asset? This is the first evaluation we are going to do, and then during the process we have a revaluation loss. So automatically we are going to recognize that an impairment, we are going to debit expenses, and we are going to do a credit to the assets. We are going to reduce the value of the assets. So now let's try to solve this example 5, so we can able to understand the concept more. Let me copy the question and then let's try to understand the question and try to solve it as well. At the end of the session, I'm going to share this solution so you can take a look at it at your own time. Good. So now let's take a look at the question, and then understanding the question is 50% to the solution. Show the relevant extract from the financial statement as at 31st December 20x8. This is the requirement to 31st December 20x8. You are going to prepare an extract. So let's read the question. An entity revalues its building and decides to incorporate the evaluation into the financial statement. Extract from the statement of financial position as at 31st December 20x7. 31st December 20x7. Extract at the close of the previous year 20x7. Now we have cost, which is 1,200, depreciation, which is 144, and we have the carrying value of 1056. This carrying value is at December. So at the start of the year, 1st January 20x8, the value of the asset that will be shown in the financial statement will be 1056. Now, the building is revalued at 1st January 20x8 at $1,400,000. Its useful life is 40 years at that date. At this date, the 1st January 20x8, that's the useful life of the asset. Show the relevant extract from the financial statement as at 31st December 20x8. So now we are going to solve this particular question. It's very simple question. So now let's start to solve this particular question. So the carrying value at 1st January 08 equals to 1056. This is the carrying value, right? The building is revalued at 1st January. So the revalued amount equals to 1,400. So it means the carrying value of the asset is 1056 and the revalued amount is 1,400. and 1400. So the revalued amount is more than the carrying value. So it means we have gain on revaluation. So we have gain on revaluation. Gain. So the amount of gain will be 1400 minus 1056, which is 344. This is the gain. So this gain, we are going to debit other component of other comprehensive income, and we are going to credit the revaluation reserve. So this will be the entry. So let me write the double entry so we can understand. So the entry will be, we are going to debit other comprehensive income equals to 344, and we are going to credit revaluation reserve equals to 344. So this is what we are going to do for the revaluation gain. So now we need to calculate the depreciation, so we can calculate the carrying value of the asset as at 31st December 20x8. So now the revalued amount at 1st January 08 equals to 1400. So this is the amount we are going to calculate the depreciation on. So we calculate our depreciation which will be 1400 divided by its useful life is 40 years at this date. As at the 1st of January 20x8, the useful life is 40 years. So 1400 divided by 40, so 35 will be charged on annual basis as depreciation. 35. So therefore, the carrying value at 31st 12 month 08 will equals to 1400 minus 35. So 1365 will be the carrying value. So now if we are going to prepare an extract, we are going to show the income statement. So extract. So we are going to show expenses, which will be the depreciation equals to 35. So what again we are going to show? Okay, for statement of profit or loss, this is what we are going to show. And for other component of equity, other comprehensive income, we are going to show the revaluation gain of 344. Under the reserve, we are going to show 344 again as revaluation reserve. And under the statement of financial position, we are going to show asset value of 1365. Asset value of 1365. So this is the entry. These are the entries we are going to do to account for this particular example. So for now, we are going to keep it simple, and we have more to look at. But when we are going to solve past questions, we are going to cover it. In terms of this revaluation recognition, whether it's gain or loss. So let's proceed. Now we are going to look at the depreciation of asset, revalued asset. Once an asset has been revalued, the following treatment is required. Depreciation must be charged based on the value less residual value over the remaining useful life of the asset. From the above example, the remaining useful life at the date of revaluation is 40 years. That's why we depreciate the asset using 40 years. Second point, the whole charge must go to the statement of profit or loss for the year. We need to expense it. Any annual reserve transfer may be made from revaluation surplus to retained earning for the additional depreciation charge on the revalued amount compared to cost. Now, we are going to look at this separately when we are talking about excess depreciation. For example, before the evaluation, our depreciation is 1,000 jones, for example. Or let's take a look at this question that we solved, few minutes ago. And the depreciation is 35. Before the evaluation, let's assume that our depreciation, is 30. Now, based on the evaluation, our depreciation has increased from 30 to 35. So the excess depreciation of 5, we need to know how to account for it as an accountant. We need to know. So now this is what I'm going to tell you now. For the additional depreciation charge on the revalued amount compared to cost, this permitted treatment under IAS 16 is to address the imbalance between a non-distributable gain held in the revaluation surplus and the reduction in the retained earnings due to the increase in depreciation charge. So this transfer will be shown on the statement of changes in equity. So now, the excess depreciation, we are going to show that transfer within the statement of changes in equity. We are not going to show it under the statement of profit or loss, and we are not going to show it under OCI. We are going to show it under the source side, the statement of changes in equity. Now for the excess depreciation, this is the journal we are going to use to account for the excess depreciation. So now, for the revaluation surplus, the depreciation on evaluation minus depreciation on the original cost, as I mentioned earlier, the previous depreciation has been 30, while the current depreciation is 35. So automatically, the excess depreciation of 5, we are going to account for it. We are going to reduce the depreciation, the evaluation surplus, we are going to debit it, and we are going to credit the retained earning. So this is the journal, and this is the double entry we need to know. The basis for this double entry is to ensure that the revaluation surplus and the retained earning, we need to reconcile the imbalance in terms of depreciation between these two guys. We need to know that as well. So now the key point, this transfer is not part of other comprehensive income. It is shown on the statement of changes in equity only. When we are going to prepare the statement of changes in equity, we are going to debit, we are going to reduce the revaluation surplus, and we are going to increase our retained earning. So now, let's take a look at example, so we can, able to understand better. So now, example 6. Example 6. Let me increase the size. Show the effects of the above on the financial statement for the year end. An entity revalued its land and building at the start of the year to 60 million. 15 million for land. The property cost 30 million. 6 million for land. 10 years prior to the revaluation. So it means the original cost of the asset is 30 million, 6 million for land, and the 24 million is for the building. This is the cost of the assets 10 years ago. And now the current value, the revalued amount is 60 million. 15 million for the land and the remaining 45 million for the building. The total expected useful life of 40 years remained unchanged. The entity policy is to make an annual transfer of realized amounts to the retained earning. Show the effect of the above transaction for the above on the financial statement for the year end. So this is the question. So let's solve this question and let's see how best you can comprehend this information. Very much important. And then now let's collect some data we can use. And an entity value is land and building at the start of the year. So start of the year, equals to 6 equals to the cost, the land, the building, sorry, land. The building cost 45, the land cost 15. Just a minute, let me rearrange my sheet. So now the land, the building, then our total. So start of year, the land is 15 million, the building is 45, and the total is 60. Start of the year. Very good. This is start of the year figure. And so now the property cost 30 million 10 years ago. So 30 million, 6 million for land. So we need to abstract this information as well. And let's take it in black. $10 years ago, value. The land cost 6 million, the building cost 24 million, a total of 30 million. Total of 30 million. So now, and what we need to do, we need to calculate the depreciation. We need to calculate the carrying value of the asset as of now before the revaluation. So now we need to calculate it. So calculate the carrying value before revaluation. Sure, we are not going to depreciate the land. So depreciation, it's only for the building. So the remaining value for the building is 24. Divide by 40 years. Total expected useful level will remain 40 years remained unchanged. So 40 years, 24 divided by 40 years, 24 divided by 40 years. So 0.6 is the depreciation. 0.6 is the depreciation. And so we are going to calculate the carrying value. So we are going to deduct depreciation. The land is not going to depreciate. So 0.6, 0.6, sorry, that's for the building. The land depreciation, is 0.00. Why is the building depreciated by 0.6? So total depreciation is 0.6. So the carrying value is 6, and 24 minus 0.6, 23.4. So the total value will be plus 6 will be 29.4. So after the 10 years depreciation, so it's 4, we need to multiply it by 10 because it's 10 years depreciation. This is per year, so times 10. So 0.6 times 10, you have 6. So this will be, the depreciation will be 6, while 24 minus 6 will be 18. 18 plus 6 will be 24. So this is the current value of the asset. So now what we need to do, and the entity policy, is to make an annual transfer. So now let's calculate the revaluation gain and also calculate the depreciation on the revalued asset, which is very much important because this is at the start of the year, so we need information at the end of the year. So we need to calculate the revaluation gain. So revaluation gain, so let's take the revalued amount. Revaluation gain, land, building, total. Land, building, total. The revalued amount is 1545 for the land, 1545, 60. Right? Then the valued amount, carrying value is now the current value, which is 6, 6 and 18. 6, 18, which is 24. So therefore our gain will be 15 minus 6, which is 9 for the land, and 45 minus 18, which is 27, plus 9, so we have total gain of 36. This is the valuation gain. So now also we are going to calculate the depreciation on the revalued amount. So depreciation, calculate depreciation on revalued amount. We are not going to charge the land, so land building total. So the revalue amount, which is 6, and the revalue amount 15 and 45, 15 and 45, which is 60, and depreciation on building so now 45 divide, now very important concept we need to know. We are going to calculate depreciation based on the remaining useful life. We have already calculated 10 years depreciation, so now we need the remaining useful life is 30 years times 1. So 45 divided by 30 will give us a depreciation of 1.5. 1.5. So 15, 45 minus 1.5, 43.5 plus 15, 58.5. So this is how we are going to solve this particular question. So now we need to account for the excess depreciation, which is very much important. And our annual depreciation we have been calculating is based on 24 divided by 40, 0.6 per year. We paid 0.6, we expensed 0.6 for over 10 years. So now let's understand the concept, right? Excess depreciation. Let's understand the concept. And depreciation at cost equals to 0.6 per year, and we expense 0.6 for over 10 years. Now the depreciation at revalued amount equals to 1.5 per year. And if we did not do any further evaluation, this 1.5 will be charged over the remaining 30 years of the useful life of the asset. So now, looking at this, we have excess depreciation. Amounts to 1.5 minus 0.6. So 0.9 is the excess depreciation. So now this excess depreciation, we are going to debit the revaluation reserve by 0.9, and we are going to credit the retained earning by 0.9. So this is how you need to solve this particular question. So let's look at the requirement again to see if further um, thing we need to look at. No, it's fine. To show the effect, we have shown the various impacts based on the analysis. So the evaluation gain, we have calculated the evaluation gain, and this amount we are going to debit the. Let me do the journal for you to see, and this amount we are going to debit the evaluation, and we are going to credit. We are going to debit the OCI, and we are going to credit the evaluation. We are going to debit the OCI, and we are going to credit the reserve. So this is the double entry, and then what next? Calculation excess depreciation. Okay, so fine. We have completed the solution to this particular question. Now let's proceed. So we can look at example 7, and on the 1st of April 20x8, the fair value of X property was 100,000 with a remaining life of 20 years. X policy is to revalue its property at its year end at 31st March 20x9. The property valued at 86,000. The balance on the evaluation surplus at 1st April 20x8 was 20,000, which relates to entirely to the property. X does not transfer to realize profit in the respect of the excess depreciation. So now let's try to solve this question. On 1st April 20x8, the fair value of X property was 100,000. 1st April, the fair value, with a remaining life of 20 years. Remaining life. X policy is to revalue its property at each year end. The year starts 1st April, it ends March 31st, 2029. The property was revalued at 86. So firstly, we need to calculate the carrying value before the evaluation. So let's calculate the carrying value at the carrying value at 31st March 09. So let me okay. Sorry. Let me just. Good to go. So the fair value at 1st April 2008 equals to 100 And then now we need to calculate the depreciation for the year, which is 100 divided by 20 years. So 100 divided by 20 years, 100 divided by 20 years. So on annual basis, it's 5,000. So 95 will be the carrying value at 31st 3-month March X09. This will be the carrying value. So now, as at 31st March, the property was revalued to this. So we look at the revalued amount at 31st March X09, which is 86. So now, based on this calculation, we have loss on revaluation loss of 95 minus 86 of 95 minus 86, a loss of 9,000 evaluation loss. So let's take a look at the question further. That will be the basis on which we are going to treat this particular evaluation loss. The balance of the evaluation surplus at 1st April 20x8 was 20,000. So it means, previously this asset has been revalued, and currently the gain under the evaluation surplus is 20,000. So now, based on IAS 16, what we need to know, whenever we have a value in the revaluation reserve, then subsequently there is a loss on revaluation. IAS 16 clearly stated that we need to account for the revaluation loss first on the revaluation surplus account. If any remaining, then automatically we are going to transfer that remaining to the expenses. So now let's understand how we are going to solve this particular question, right? And then the value in evaluation reserve equals to 20,000, equals to 20,000, right? And the current evaluation loss is 10,000, is 9,000 loans. So it remains 11,000 loans within the revaluation reserve. So now what I'm saying, let's take a look at the question technically. The amount in the revaluation reserve is 20,000. Now currently we had a revaluation loss of 9,000 loans. So basically we need to offset this revaluation loss against the revaluation reserve account. So the remaining value in the revaluation account will be 11,000 loans. So this is the concept you need to know. Now let's assume that let's assume a question so we can understand. Let's assume the amount in the evaluation in the evaluation reserve is $5,000. So show the impact. So now if the amount in the evaluation reserve is 5,000, let's show the impact so we can understand. Oh, sorry. So amount in evaluation reserve is 5,000. And evaluation loss, which is 9,000. So now the IAS 16 is saying that we need to ensure we use the evaluation loss first against the evaluation reserve. If any outstanding, we need to expense that particular amount. So now what we are going to do, we are going to show and we are going to debit this evaluation reserve with 5,000 loans. So we are going to treatment in evaluation reserve, right? And so the value, sorry, the value in the evaluation reserve is 5. So we are going to show part of the 9,000 loans. So part of the evaluation loss, we are going to show it 5,000 loans. So currently in the evaluation reserve, the value is 0. So how are we going to account for the remaining 4,000 loans? Very important question we need to know. So the remaining 4,000 loans, we are going to expense it. Simple. So for the remaining 4,000 loans, the remaining loss, which is 4,000 loans, we are going to debit expenses 4,000 loans. And it obviously it's an impairment, so we are going to the whole of the losses we need to be credited to the asset account. So now this is the concept you need to know, and so far this is all what you need to know about IAS. Sorry. This is all what you need to know about IAS 16. So you need to know how to account for the evaluation loss when there is an existing value in the evaluation reserve. If the loss is less than the evaluation reserve, it's fine. We are going to offset all the loss against the evaluation reserve. But if the loss is more than the value in the evaluation reserve, then it means we are going to offset the total within the evaluation reserve. Then any remaining amount should be expensed. Simple. This is what you need to know. Then we are going to look at how we can account for disposal, for revalued assets. And then for now, we are going to keep it short. And then during our live online classes, we are going to solve these kids questions. I have 5 kids questions for us that we are going to solve. But let's go through this first one. And on 1st July 20x4, I'm going to read it. I'm not going to solve. Experimenter opened a chemical processing plant. The plant was due to be active for 5 years until 30th June 20x9. From the 1st of July 20x4 to 30th June 20x9, it's 5 years. When it will be decommissioned, at the 1st of July 20x4, the cost of decommissioning the plant were estimated to be 4 million in 5 years' time. So it means when we're talking about dismantle, this is the same concept. This is the past question. So it means the dismantle cost or the decommissioning cost in 5 years' time will be 4 million. So we need to discount this 4 million to present value as at the 1st of July 20x4. What will be the equivalent value of this $4 million? Experimenter consider that the discount rate, the R we are going to use in the discount factor is 12%, is appropriate for the calculation of the present value. And the discount factor of 12% for the 5 years is 0.567. So it's simple. We don't need to use the discount factor formula again. But if we decide to use it, we are going to arrive at the same 0.567, discount factor we are going to multiply against the 4 million. So this is the concept you need to know. Now, look at the requirement. What is the total charge to the statement of profit and loss in respect of the decommissioning? This is in respect of only the decommissioning for the year ended 30th June. And if we look at the question, we are not talking about the amount we are going to capitalize as assets as well as we are going to recognize as liability. So this present value we are going to calculate 0.567 multiply against the 4 million will give us the value that we are going to capitalize at the start of the year, and we are going to credit the liability. Now look at the requirement. What is the total charges to statement of profit and loss? So it means, as at the 30th of June 2025, we are going to unwind the liability. We are going to unwind the liability from the 31st of June 20x5 to the 31st of June 20x9. But now the question only limits us to 30th of June 20x5. So we are only going to unwind this particular interest, this particular liability for just an year. So this is how we are going to solve this particular question. Just a brief, when we are going to look at the live online class, we are going to see how best we can, solve the question so everyone can understand. Also, you can solve it on your own, then you can ask me a question. Also, look at this one. It's talking about gain on the property. An entity purchased a property for 6 million on 1st July 20x3. The land element of the purchase was 1 million. We are not going to depreciate it. The expected life of the building was 50 years. We are going to depreciate the building over 50 years. Its residual value is nil, 0. On 30th of June 20x5, after 2 years, the property was revalued to 7. So we are going to calculate the current value as at the 30th of June 20x5 and compare the current value with the 7 million revalued amount to determine whether there is a gain or loss on the valuation. Then also the land element figure is given 1.2, the building is given. Then on 30th of June 20, the property was sold. So also we need to calculate whether there is a gain or loss. But look at the requirement. What is the gain on disposal of the property? So the requirement is, the question is asked to calculate the gain or loss on the property. So now we are going to, we are not going to solve it now. We are going to solve the question when we are doing our live online classes. So we have a lot of other practical past exam questions we need to solve. So for now we can keep it short, and when we are going to look at the live online classes, we are going to see how best we can solve this question. So I want to use the opportunity to thank you all, and bye bye to everyone.